Are you really getting the full picture when it comes to dividend stocks versus growth stocks? Because most investing content out there picks aside and ignores the messy, real world stuff that actually affects your money. Things like taxes eating into your returns, panic selling after years of patience, or feeling trapped because cashing out means you can never get back in at the same price. If any of that sounds familiar, you are in the right place. By the end of this video, you will know exactly how each investing style works, which one fits your situation, how to use both together in a smarter way, and how to stop making the costly mistakes most investors do not even realize they are making. Let us get into it. So let us start with dividend stocks and why so many people fall in love with them. When you own a dividend stock, the company shares a portion of its profits with you on a regular basis, usually every quarter. You do not have to sell anything, you do not have to time anything, the money just shows up. That is a huge deal for a lot of investors, and for a very good reason. I can tell you from my own experience, trying to balance a demanding career while making sure I'm fully present for my wife and daughter, my perspective on this completely shifted. I didn't want to be glued to stock charts on a Saturday morning. That feeling when a dividend payment quietly hits your account while you're just out enjoying a weekend with your family, it completely changes how you view passive income. Think about it this way. With growth stocks, your gains are locked inside the stock. You only see that money when you sell. And here is the catch most people do not talk about. If you need cash 1 month and you sell some shares to cover it, you have to buy back in later at whatever the market is doing. If the stock went up while you were out, you are paying more to return to the same position you were in before. It is a frustrating cycle that forces you to play market timing games just to manage your own money. Dividend income does not work like that. It comes to you regularly without requiring you to exit your position. That is a genuine advantage, especially if you are in or near retirement. Now, not all dividend stocks are created equal. You've got your consumer staples like Coca-Cola and Procter and Gamble, companies selling everyday essentials that people buy no matter what the economy is doing. You have got real estate investment trusts, which let you collect rental-style income without owning actual property. You've got financial companies like big banks and insurers, and energy giants like Exxon and Chevron that generate strong cash flow once their infrastructure is up and running. One thing to watch out for, though, is the dividend yield trap. A yield above 6 or 7% can look irresistible, but it sometimes signals trouble. A struggling company might keep its dividend high to attract investors, but if the business keeps underperforming, the stock price falls, and suddenly that attractive yield cannot make up for the loss in value. Always look at the health of the business first. The dividend should be a reward for owning a great company, not the only reason you own it. Now let us talk about growth stocks, which operate on a completely different logic. These companies reinvest every dollar back into expanding the business. No dividends, no cash payouts, just the belief that the company will be worth significantly more in the future. Think Amazon in its early years, Nvidia before the AI wave, or Tesla, when it was still considered a long shot. Having spent over 15 years in the tech industry building software architecture, I've had a front row seat to this kind of explosive growth. It's incredible to watch a company scale from a promising technical concept into a global powerhouse, and the financial returns can be truly life-changing if you have the conviction to hold on. The upside is massive potential. Between 2010 and 2020, the broader market surged over 400%, fueled largely by technology growth stocks. But here is where honesty matters. A lot of investors who were in those stocks through the good years still ended up worse off because of one thing: emotional decision-making. Holding through years of volatility, only to panic sell right before a recovery, is one of the most painful and common investing mistakes out there. Some investors held strong through events like COVID, only to sell near the bottom trying to protect gains, and then watch the market recover without them. If you are currently sitting on a large cash position after a panic sell and wondering whether to get back in, The strategy of dollar cost averaging, putting money in gradually over time at regular intervals, is generally more reliable than trying to time a perfect re-entry around earnings reports or news cycles. That is still market timing, just dressed up differently. So which one is better? Here is what nobody really tells you. It is not about picking a side. It is about using each type of stock in the right place, especially when taxes are involved. This is where account strategy becomes one of the most powerful and underused tools in investing. If you are earning dividend income inside a regular taxable brokerage account, the tax bill comes every single year, whether you reinvest those dividends or not. Over 2 decades, that is not just money lost to taxes, it is money that never got to compound. Growth stocks have a built-in tax advantage in taxable accounts because you only owe taxes when you actually sell. Flip that logic around for tax-advantaged accounts, and the strategy gets really interesting. Holding your dividend-paying stocks inside a Roth IRA or traditional IRA means those dividends grow without being taxed along the way. Inside a Roth specifically, if you follow the rules, that growth can come out completely tax-free. Meanwhile, keeping your growth stocks in a standard brokerage account lets you benefit from long-term capital gains tax rates, which are typically lower than ordinary income rates, as long as you hold for over a year. This combination, dividend stocks in tax-advantaged accounts and growth stocks in taxable accounts, is one of the most tax-efficient setups an individual investor can build. It is not flashy, but it is incredibly effective over the long run. The data backs this up too. Research from Hartford Funds suggests that roughly 34% of the total returns from the S&P 500 since 1940 have come from dividends alone. That is about a third of your long-term gains just from staying invested and collecting payments. Dismissing dividends as boring or old-fashioned ignores decades of compounding evidence. And here's the bigger picture. The best portfolios are not purely one or the other. Young investors with a long time horizon might lean heavier into growth, while those closer to needing income lean toward dividends. But having both structured thoughtfully across the right accounts gives you growth potential, regular income, and tax efficiency all working together. Building long-term wealth is a lot like architecting a robust piece of software. You need different components doing different jobs, so the whole system doesn't crash when the market puts it under pressure. The key question that ties all of this together is this: what do you actually need your money to do for you? And when do you need it to do it? Your goals and your timeline matter more than any debate about which style is theoretically superior. Now, here's something I want to leave you with. Think about your own situation right now. Are your dividend stocks and growth stocks sitting in the most tax-efficient accounts for your goals? Drop your answer in the comments below. I read every single one, and the conversation down there is always worth joining. If you learned something new today, or if this gave you a fresh way to think about your portfolio, please hit the like button, subscribe, and ring the bell so you never miss our latest investing insights. It genuinely helps this channel grow and keeps this kind of content coming your way. See you in the next one.